Gary Wagner from thegoldforecast.com is back once again to give us the beat on the recent beatdowns in gold and silver despite higher inflation numbers. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Gary Wagner, welcome back to Metal Money. How are you doing?
I'm doing very well. Thanks for asking. How is Singapore?
Singapore is doing fine. We're doing great, hanging in there just like everyone else. Gary, you recently wrote an article about the CPI, PCE, and Jerome Powell's recent testimony, and you wrote where Powell stated inflation will likely remain elevated in coming months before moderating. What do you think the definition of Powell's moderating is, and what do you think he plans to do?
Well, first of all, I think he's using that terminology because honestly, they do not know. As we spoke about pre-show, one of the statements that Chairman Powell made was that they have no experience. It's never been an instance where a government had to reignite an economy, ours $20 trillion economy, after being shut down for a year and a half. So they have no reference to go on. So when they say it's moderating, it is lasting longer and going higher than they originally anticipated. And it's the only really the word usage to kind of not scare the public. But the truth is they don't know. They don't know how long it will last. They don't know how high it will go because, as you said, they cannot control it.
Yeah, it's a great point. Well, let's hope they do figure it out and figure it out soon. And despite the Fed's acknowledgement of inflation running a bit hot, gold, the safe haven asset that fights inflation, it's not making any significant gains right now. Why do you think investors have not made their way to gold?
Well, I can reference that to 2 weeks ago, 3 weeks ago, even half of last week. And that is because the equity markets here in the United States were trading to all-time highs. Liquidity theory simply states that an investor will take his capital and place it where he believes or she believes they will get the greatest return. With equities running like they have been, we had a risk-on environment that kind of moved away from gold. The other thing was we were getting crazy upticks in the yields. For example, the 10-year note, and that went up to like 1.7. It was in anticipation under the belief that interest rates were going to be raised sooner than later. However, Powell made it clear that we're not going to see it come off of the 0 to 0.25% this year, and probably not next year, but in 23, we might have 2 rate hikes. He has said that right now, their dual mandate, which has always been full employment and inflation at 2%, has been adjusted to really focus on this full employment. And that's why they're letting interest run hot. The problem that I personally have is there's 2 basic gauges that the government puts out. And they use the gauge that strips out energy and food, and that is sitting at 3.4%. Now, if you look at the CPI, which is also released by the government, that adds in food costs and energy costs, and that went up 0.09% last month, which takes an annualized return to 5.4%. That's a tremendous amount of inflation. And the key is they've made it clear about full employment being the primary focus, so they'll let it run hot. Their not excuse, but their rationale behind it is all of it will dissipate because there's bottlenecks. Used cars accounted for 1/3 of it, and that's a matter of not having enough microchips for the new cars to build them. That is a temporary inflationary force. I acknowledge that, but they can't control the cost of food nor energy. And going into the summer months, at least here in the United States, with vaccinations up, people are going to get out and want to drive on the holidays. And so we're going to have an increased demand. And so I don't see oil going down all that much. And those are the primary inflationary forces at play right now in terms of goods and services. So the Federal Reserve is in a tough spot. There's no question about that. They're dealing with something that has never happened before, but they're smart people. And so I have faith that they'll do as best of a job as they can. The other concern that I do have is that Janet Yellen spoke to Congress about 2 weeks ago. And what she said is that you have to raise the debt ceiling for us because I will not be able to pay my bills in about a month to 2 months. The US, United States, has never not made an interest payment or serviced their debt and paid their bills. It's never happened. And I believe it never will, because if it did, that's the beginning of the end. And I don't think that is the case. But I believe it was President Trump that actually capped it. So they've got to uncap it over the next month, month and a half. So that's an issue also. It's all of these forces working together. And now with the new variant kind of clustering different areas that aren't opening as quickly, that is making the Federal Reserve kind of act by the seat of their pants as they go along, because they are basing all of their decisions on data. And as the data changes, so will their actions.
Gary, you're in Hawaii, and I grew up in Hawaii, and we can look almost anywhere, and we are going to see waves. And in your charting, you recently spoke about waves in the bigger picture of things and a major fifth wave regarding gold. I'm going to pull up this chart here, and could
Okay.
you take some time to paddle out with us and help us ride these waves you recently mentioned, the Elliott and Impulse waves?
Yeah, in essence, what I did is standard forecasting in terms of where I believe gold will end up. Now, first, realize we're looking at a multi-year cycle. We're not looking at something that's going to happen in 2 weeks or a month. But in essence, you saw a long third wave. And from there, you can see that it comes down and we get our fourth wave. The fourth wave comes in roughly at 1920. And then we went into a count, five count, which is 1, 3, and 5. That's the impulse phase up, and the two corrective waves, which is 2 and 4. I believe we've completed 1. I believe that we've completed 2. And so what I've done with the yellow lines is I've simply forecast where I think wave 3 of wave 5, so still I was a ways further to go, even on this forecast, could go. And the standard practice is, as you can see, about in the middle of the chart, there are 2 yellow lines, one right under the 4, and then on top where it caps. And so that's wave 1. And so we use that as our benchmark. As the market corrects, when we have that V formation, you're going to see the number 1749, and that's where we concluded wave 2. So the projection that you're looking at is taking wave 1 and doing a Fibonacci extension of 1.618% to come up with our forecast. You can do it one of two ways. Either do that, or you can take wave 1, and the size of that would be wave 5. I prefer to do it the way that I've done it. But that is looking at 2141, a new all-time record high in gold. And I believe that that is the road we are on.
All right, let's ride these waves back to shore and talk short term. In your technical analysis, what do you see happening with the gold price as far as short term resistance and support levels?
Okay, now on this chart, you have Fibonacci retracements, which begin roughly at 1676 and conclude at 1920. And as you can see, the lows that it hit today just went under the 50% retracement. And just below that is the 100-day moving average at 1791. We did go long this market, and our stop is below the 100-day moving average. And that's because we think that there's major support there. Now, in terms of resistance, we've got a really good band, because if you look at the chart, the 38.2% at 1826 and the 200-day moving average are right in the same zone. So that's going to be our next level of resistance. And above that is about 1838, and that is our 50-day moving average. Now, the beautiful thing, if you look at that chart, it shows you that we've recently had a golden cross in which the 50-day crossed above the 200-day, and that's significant.
I'll get one last question here on silver. it does seem to have some heavy resistance at about the $28 level. And despite that, it does seem to continue to be, though, on an upward trend with higher lows. Gary, short term, silver, looking at the tail end on this chart being the month of June and into July on this daily chart here, does silver in the short term look to be running out of steam?
Silver has been caught in a sideways band. I've been looking at major support at about 25.11, roughly there. We had a tremendous move down today, 56 cents, about 2.09%. But now it's up about $10. Same with gold. Gold is back to about 18.19 when it closed on Friday about 18.11. So I think that what we're seeing is a delayed reaction to this tremendous downtick we got today in the yields of the 10-year note. They went down to 1.17 and they settled at 1.9. They were as high as at 1.09, but they were much, much higher just a week ago. And that was, to me, unrealistic when they got bid up high, and that pressured both gold and silver lower. But recently, especially today, we saw treasuries and US debt as a whole, the yield or the interest rate that they pay the bearer come down greatly. And I think you're getting a delayed reaction as overseas markets realize that we had dollar strength this morning. The dollar is probably coming in weak right now because of that. When you offer yields that are much lower than what you can get in the Bundesbank or other different banks on their sovereign debt, you are going to have the large industrial traders, the professional traders, as well as countries moving their money into debt instruments that will provide some nice yields, the nicest yield possible, and the U.S. is not the place right now.
Gary Wagner from thegoldforecast.com. We appreciate your time and all that you've brought to light here, and hope we can do it again soon.
Absolutely. A pleasure as always. Look forward to talking to you again.
That was Gary Wagner from thegoldforecast.com going over what's going on recently with gold and silver in these inflationary times. As always, leave your thoughts in the comments section below and remember to keep it liquid, keep it real, and I'll see you on the next episode of Metal Money.